You wake up, shuffle to the mailbox, and find the letter you've been both expecting and dreading. It's the Social Security statement, an official piece of paper that's supposed to represent safety, continuity, and the payoff for decades of work. You tear it open at the kitchen table, coffee cooling beside you, and there it is in clean black ink, your monthly benefit. It's not a surprise, but it hits differently today, because the numbers in your life aren't just numbers anymore. They're rent, power, medicine, groceries, grandkids' birthdays, and 1,000 small moments you promised yourself you wouldn't skimp on in retirement. Then your phone buzzes with another headline about prices, deficits, and the next policy move. You take a breath and you realize something that millions of retirees discover in the quiet. Social Security is not enough. That's not an opinion. It's a reality check. Here's what the data has been trying to tell you, gently at first, and now with a much louder voice. The average retired worker benefit today is hovering around a couple $1,000s a month. It moves a little with the annual COLA adjustments, but when you subtract rising housing costs, utilities, food, and the one-line item that never seems to stop, healthcare, you see what's really going on. Health costs don't just inflate, they compound. A 5% rise this year, layered on last year's increase, layered on the quiet march of co-pays, premiums, and prescriptions. Meanwhile, COLAs are like a bandage on a wound that keeps reopening. They reflect a snapshot of inflation. They don't erase the compounding effect that slowly, quietly moves money out of your pocket and into the economy at large. People like to debate the trust fund date, 2033, 2034, 2035, depending on the estimate and the assumptions. The exact year is less important than the direction of travel. Without legislative fixes, the math says benefits could be trimmed in the neighborhood of 20% when that day hits. Will Congress let that happen? Probably not in a straight line. But do you want your security tethered to votes, headlines, and last-minute deals? Or would you rather build something that doesn't need anyone's permission to hold value? This is where most people turn to what they've been told. Take more risk, chase performance, hope the market keeps climbing forever. And stocks, real estate, and entrepreneurship can all be powerful wealth engines, no doubt. But a reality check means we look at what holds its ground when the winds shift. It means we consider something most financial media barely whisper about unless it's spiking. Silver. Not as a shiny speculation, as a tool. As a hedge against the part of life that a monthly government check, however helpful, cannot control. Inflation, monetary experiments, and supply-demand realities that live outside the walls of Washington or Brussels or any central bank. Let's talk about what silver actually is in the real world. Not a ticker symbol, not a talking point. A metal that's irreplaceable in the technologies we're building the future on. Silver is the best conductor of electricity we've got. That's not a marketing line. It's basic physics. When you place a metal with unmatched conductivity into the center of an economy that's electrifying everything, cars, data centers, homes, grids, you are placing a scarce input into a rising demand curve. Solar panels don't function as designed without silver paste. Electric vehicles need silver throughout their circuitry, not just in some niche component. 5G and its successors need precision electronics. Data centers, the beating heart of AI, run on vast systems packed with components where silver plays roles big and small. This is not someday. It's right now. Industry estimates put solar's annual silver demand well north of 100 million ounces, and that's with continued thrifting, the engineering practice of reducing material per unit. Even with thrifting, total consumption is rising because volume is crushing efficiency gains. Then there's the supply side, which is the quiet, stubborn part of the story. Silver is mined in two primary ways: by a small group of miners whose core business is silver, and more often as a byproduct of mining for other metals like copper, lead, or zinc. That means even if silver prices rise, you don't necessarily see a proportional jump in silver output, because the production responds to copper's cycle, not silver's. Add to that the permitting challenges, declining grades in mature districts, and geopolitical uncertainties in major producing nations, and you've got a setup where turning on more supply isn't as simple as flipping a switch. Over the last few years, the market has recorded repeated deficits, demand outpacing supply by tens and tens of millions of ounces annually. A couple of years of that doesn't tell the whole story. Several years in a row changes inventories, pressures wholesalers, and gradually tightens the spring. Look hard at what happens when that tightening meets a price system dominated by paper promises. On futures exchanges, where price discovery happens minute to minute, 1 ounce in a vault can underpin many claims in the paper market. It's normal in commodity finance. It's not a conspiracy, it's structure. But structure has limits and stress tests. The ratio of paper interest to immediately deliverable, registered metal oscillates. There are days when open interest implies claims that are many multiples of quickly deliverable ounces. Most participants don't actually want delivery. They want to trade. Until they don't. Until a handful of players decide they'd rather hold the thing than the promise. That's when price gaps, premiums widen, and retail investors wonder why a silver coin costs more than the spot price they saw on TV. The premium is the price of immediacy, the price of certainty, and the price of minting, fabrication, and logistics when the pipeline is strained. This is where the narrative turns from theory to the realities of people's lives. I want you to meet an ordinary couple. Call them Tom and Elena. Tom ran a small HVAC business. Elena taught part-time music lessons. They did most things right. They set aside, they paid off the house, they kept a modest portfolio of index funds, a little cash. They assumed that between dividends, drawdowns, and Social Security, they'd make it work. In 2021, they started noticing a pattern. The grocery bill didn't snap back. Gas fluctuated, sure, but everything else seemed to ratchet higher and stick. By early 2022, it wasn't an annoyance. It was a line item that forced trade-offs. They weren't going hungry. This wasn't tragedy, but it was a stubborn squeeze. Tom stumbled into a local coin shop, not because he was a gold bug, but because he remembered his grandfather talking about keeping something real. He bought a small stack of silver rounds, more symbolic than serious. A year later, when they rebalanced and raised a little cash for a roof repair, Tom sold part of his small stack for a gain after accounting for premiums. It didn't make them rich. It made them resilient. And that's the point. Resilience is the antidote to surprise. Now, let's go deeper into price behavior, the technical story that sits on top of the fundamentals, like a heartbeat. Long-term charts show silver capped near the psychological and structural ceiling that lived around $30 for years. Think about that zone like an old attic door, painted shut, stiff from disuse, but not immovable. You test it once, it creaks. You test it again after time, it gives more. Market memory collects at levels like that. Sellers step in, algorithms chase mean reversion, and then, one day, when enough underlying demand meets thin liquidity, you don't get a gentle step higher. You get a surge, a candle that leaves people blinking. If a weekly close clears that region with real volume, the measured moves from long consolidations don't whisper, they shout. The next magnet zones often line up in the mid to high 30s. Beyond that, there's a historical echo near the old 2011 zone, and while history doesn't repeat line for line, it rhymes with style. A breakout with momentum, rising 200-week moving average, and the gold to silver ratio turning down from stretched levels becomes a roadmap. Not a guarantee, but a set of road signs. The ratio itself matters. When it sits at elevated levels, for example in the 70s, 80s, or higher, it's telling you silver has lagged gold. When that ratio compresses, silver is usually the one doing more running. Why does the ratio matter now? Because the world's biggest, most sophisticated buyers, the central banks, aren't buying silver in bulk. They're buying gold, and they've been gobbling it up at a pace that startled even seasoned analysts in recent years. That's the tell. They're not playing a one-year game. They're building optionality against currency risk, sanction risk, and geopolitical choke points. And while that's primarily a gold story, it ends up being a silver story too, because silver is the smaller sibling in the precious complex. Money flows into gold, and when gold moves decisively, silver often follows with leverage. Add the industrial demand piece, and silver gets to wear two hats, monetary and industrial, at the same time. That dual identity is a feature, not a bug. Let's walk through a few concrete supply notes that tend to hide in footnotes. The biggest silver-producing countries include Mexico, China, and Peru. In several of these regions, miners are facing a combination of stricter environmental permitting, local community negotiations, and the inevitable geology of older districts. Grades decline over time, and it costs more to pull the same ounce. Cost curves aren't static either. Fuel, labor, and input costs swing. There were years when all-in sustaining costs on some primary silver operations edged higher, even as the headline price wasn't generous. And remember, for byproduct silver, it's copper's dance, zinc's rhythm that sets the steps. If those markets aren't screaming for expansion, you can't just conjure silver. That's why multi-year deficits keep mattering. They chip away at a buffer people assume is permanent. Zoom out again. The geopolitical backdrop is shifting under our feet. Trade wars aren't just about tariffs. They reshape supply chains. Sanctions create dollar workarounds. New alliances among commodity-rich nations aim to control the toll gates. De-dollarization isn't a switch. It's a slow engineering project by countries that don't want a single point of leverage deciding their fate. In that world, real assets with global utility aren't luxuries. They're strategic. Silver sits in a sweet spot. Not so expensive that only institutions can touch it. Not so niche that demand is fragile. It's woven into the power grid of the 21st century. You can see the institutional fingerprints without conspiracies. When precious metals ETFs see outflows during periods of risk-on euphoria, price may sag temporarily, but the metal doesn't vanish. It shifts hands to buyers who see value. Then, at the turn, perhaps when rate cuts loom or when a liquidity event forces risk repricing, watch the flows reverse. Watch premiums on allocated products tick up. Watch deliverable stocks get drawn down a little faster. And check the positioning of commercial hedgers versus managed money in futures reports. When commercials have covered shorts and become less negative while trend followers are leaning one way, asymmetric moves the other way become more likely. It's not the crystal ball. It's the weather report. Carry an umbrella when the clouds are building. Now I want to pause for a personal word, because this matters for people planning serious retirement moves. If you're sitting on $100,000 or more across retirement accounts, and you've wondered how people legally hold physical precious metals in those accounts without tripping tax penalties, I put together a straightforward free guide that explains how gold IRAs work. It walks through the basics, the custodianship, and how folks allocate, often using gold as the core with a measured slice to silver, depending on risk tolerance. If that's relevant to you, it's in the description. Worth a read. Then set it aside and come right back, because the big picture we're mapping out doesn't wait for perfect timing. It rewards preparation. Back to the reality we're all living in. Interest rates rose to fight inflation, then paused. Then markets began debating when they'll pivot lower again. If inflation proves stickier than the headline suggests, or if growth wobbles at the same time, policy will be trapped between two masters. That's when real yields become the conversation. Precious metals historically respond more to real yields, the return you get after inflation, than to nominal rates. Negative or falling real yields are a tailwind. Add fiscal deficits that require constant issuance of government debt, at the same time as major international buyers diversify, and you have a bond market that must constantly find willing hands. The marginal buyer's mood matters. A more cautious buyer, or a buyer who demands higher real compensation, is a boon to assets that don't require anyone's balance sheet to exist. History is helpful here, if we read it for patterns and not prophecies. In 1971, when the dollar decoupled from gold, it set in motion a decade of monetary adjustment. Inflation didn't spike in a straight line. It rolled in waves, punctuated by policy responses that sometimes arrived late and sometimes overshot. In 1979 to 1980, silver reached its famous spike near $50 under circumstances that were unique. Short squeezes, storied speculators, but the level etched itself into market memory. Fast forward to 2008, the crisis smashed everything. Silver cratered, and then, once the system found its shaky footing and the flood of liquidity turned the tide, silver ran hard into 2011. The lesson? Liquidity and confidence are flip sides of the same coin. When confidence drains, people grab lifelines. When liquidity floods, they chase hedges. Both conditions can move precious metals in powerful ways. More recently, 2020 delivered a fast motion version. A liquidity panic sent silver into the teens, then the policy response, supply chain shocks, and a digital rush propelled it back near 30 in months. If you were on the sidelines waiting for it to feel good, you didn't get a postcard announcing the turn. You got a vertical candle, then another, then a market with a new personality. That's how these moves often arrive, like a thunderclap on a humid afternoon. So where could we go from here? Build a simple conservative scenario. Suppose gold settles into the mid-2000s and eventually tests higher. Call it a pathway toward 2,600 or even 3,000 over a cycle. If the gold to silver ratio compresses from an elevated range down toward 60, you're looking at silver in the mid-40s. If it compresses toward 50, you're looking around 52 to 60. If risk appetite and a real squeeze coincide with a ratio in the 40s, levels we've seen before in other cycles, You're staring at a silver price that starts with a 6 or even a 7. That's not hopium. It's math. Not a promise, but a map. Meanwhile, against that upside potential, your downside over long horizons tends to find support near where mining economics start to bite. Below the marginal cost, supply quietly self-corrects. Add in the fact that retail premiums and wholesale dynamics support the floor during tight times, and you realize silver has a built-in mechanism that blunts the worst of extended declines when physical markets are firm. This brings us directly to the heart of retirement reality. No one is suggesting you replace your Social Security or your investments with a pile of metal under the bed. That's not a plan. That's a posture. What we are saying, clearly, is that a measured allocation to precious metals, with silver playing a tactical role and gold playing the strategic core, is one of the few hedges that does not require a functioning counterparty at the moment you need it. It just exists. It sits there, indifferent to the noise, immune to bankruptcy, not anyone's liability. That quality is priceless when uncertainty peaks. Let's confront the objections head-on, because you may already be thinking them. Isn't silver volatile? Yes, more than gold, both directions. That's why it's a satellite position, not the core of your net worth. What about premiums? They can bite in retail products during surges. The solution is to be early, to shop around, and to understand product tiers. 1-ounce government coins tend to carry higher premiums than private rounds, and larger bars often carry lower premiums than both. What about storage? You have options. A home safe for a modest allocation, a professional depository for larger holdings, and for retirement accounts, qualified custodians who handle the chain of custody. What about taxes? There are rules, and they vary by jurisdiction. That's why planning matters. Use the right account for the right asset and the right horizon. And yes, there's an emotional piece here too. Silver is tangible. You can hold it. Some people scoff at that as old-fashioned. But when you've lived through enough cycles, you start to value the simplicity of something that doesn't ask permission to be real. You don't have to love the shine. You just have to respect the utility. We haven't talked about market structure enough. Price discovery often happens in New York on futures, settled ultimately in cash or in deliverable bars if demanded. London's market, the LBMA, operates an over-the-counter system for large bars, where clearing members move metal in a network that runs on trust, documentation, and the physical reality of good delivery bars. The bridge between the two, through exchange for physicals, lets participants traverse paper and physical markets. This is fine in normal weather. In storms, the bridge gets crowded, and when that happens, the players who need certainty will pay for it. Coin shops show out of stock on popular items, wholesalers backorder, and mints extend lead times. If you've never lived through one of those windows, talk to someone who has. They'll tell you about refreshing websites, phoning dealers, and paying premiums they swore they'd never pay just to get product. The goal is to position before that. Quiet accumulation during boring months, not frantic buys during loud weeks. Let's not ignore the role of technology cycles either. AI isn't just a buzzword. It's a power story. More data centers, more GPUs, more cooling, more grid upgrades. Every watt you want to deliver efficiently runs through metals that move electrons willingly, and silver is king in that realm. Grid modernization, high-voltage DC lines, distributed solar on rooftops, utility-scale arrays in deserts, all of these are silver positive. Will engineers keep trying to thrift? Absolutely. But even if you cut silver per unit by 10 or 20%, if you double or triple the number of units, total demand surges. That's where we're headed as the world electrifies transportation and tries to hold down emissions without turning off the lights.